I'm joined by Matt Werner, portfolio manager with Chilton Capital Management. So Matt, we know that there are going to be more generalist investors entering the REIT space with the changes to the global industry classification standard. What are some of the road signs they should be watching out for as they start to put their money in REITs?
That's a good question, Alan. There has been a lot of new generalists looking at the sector, and I think coming from the REIT dedicated crowd, we are glad to have some new interest in changing in the guard in the investor base, but there are some things they need to be looking out for. Specifically, high yield, dividend yield companies that are the result of having higher than normal payout ratios, higher leverage, things like external management all come to mind. But really at the end of the day, I think the location thesis is something that should not be ignored at all. And a company that may be looking attractive from a dividend yield perspective could be that way for a reason. And being mindful of risk should always be a top of mind decision when looking at a company, and that long-term risk is lower by having a lower dividend yield today.
And what kind of pricing are these new investors going to be looking at? I mean, how do you see REIT valuations right now?
REIT valuations look cheap on almost every metric that we look at today. We specifically look at NAV, and I hope the generalists do as well, and REITs are trading at a pretty significant discount to their NAV. But even on a multiple basis, which has been somewhat of the preference they've looked at, REITs are trading at multiples that they haven't seen for 4 or 5 years, despite having very healthy and robust fundamentals, great balance sheets, and like I said, low dividend yields with hopefully a very visible path for dividend growth.
Let's look ahead. Sectors that you expect to outperform in the next year or two?
Sure. So we think from a fundamentals perspective, there's a lot of tailwinds behind sectors like West Coast office and industrial, but industrial specifically is, I think, priced accordingly today. There's some other sectors that I think are a better chance to produce very strong total returns for investors that check the box not only for strong fundamentals but also from an entry point of view, and that would be self-storage, office in general, as well as lodging, which I think is trading extremely cheap today. And if they could just go from trading extremely cheap to slightly cheap, investors would enjoy that ride.
Well, Matt, thank you so much for your time.
Thank you, Alan.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.